Well, hello there. Welcome to Module 1. This is all about the stock market. I think you're going to enjoy this module very much. This is a great introduction to what the stock market is and how it works. So let's get started. So the first thing, of course, I need to give a disclaimer that basically says that you can lose money trading stock options. All right, look, we'll talk about this again, and I'm not going to guarantee you won't, but I'm also going to say that I will do everything I can to keep this from happening. And again, I've highlighted the yellow. Small market movements will have a great impact on your trading account, and this can work against you, leading to large losses, or it can work for you, leading to large gains. Please remember that. Okay, today, some of the things that you're going to learn are how to value a stock. You're going to learn some important definitions, including PE, EBITDA, net margin, ROE, and others. And most importantly, you're going to learn what makes the stock price go up or down. And even more importantly, you're going to learn how the stock market really works. So let's get started. Here we go. So what are stocks? This is a good question. A lot of people don't even fully understand what stocks are. Well, stocks are literally ownership. So you own a piece of the company. You physically own a piece of that company. Seriously. And common shareholders have the right to vote on major issues affecting the company, like mergers and acquisitions, liquidations of the corporate assets, and some other things. So it's important to understand that you do own the company. The thing is that most stockholders own such little pieces of the company that their voice isn't heard. That's why these major corporations, like mutual funds who own big pieces, may have a bigger voice than you have. By the way, you also may be entitled to dividend payments as a shareholder of the company. Just like if you owned a company and the company was profitable and you were taking payments, you would take those payments in form of dividends, assuming you didn't work for the company. So what kind of companies do you want to own? Well, think about this. There's really only one answer. Good ones, of course. So let's talk about analyzing stocks and how to analyze stocks on the stock market. So the first thing you need to do when you go to any stock market site, now I happen to use CNBC. I just happen to use it. It's no big deal. You can use any one you want. This is a screenshot from CNBC, and this obviously is Apple Computer. And this is what you'll see if you look at the screenshot, or if you look at the computer, if you go to CNBC.com, and you put in the ticker symbol AAPL, this is what you're going to see. So the first thing you want to do is you want to look at the top part. And the top part is important. Now, if you notice that there are different days of charts. So this happens to be a one-day chart. And the one-day chart shows you what happened during the day. Obviously, this wasn't a good day. If you bought it at the top and it went down to the bottom, it is what it is. But it happens that way. Those things happen. So you can see that by the way, the market, and you should know this, the market opens from 9:30 to 4 o'clock on weekdays. And you can trade, and this is what this shows. This shows the one day. Now, the price that you see here is the current price, 115.82. So this is the current price on the day that I took this snapshot. You'll notice there's something else. There's something else called extended hours, and you can trade the market on extended hours. Now, only certain traders can do this, and frankly, it's not necessary. But just know that it is available, and this is the extended hours price. So since the market closed, the stock actually went down 22 cents. You'll also find in the morning, a lot of times I'll look at the stock market before, or look at certain stocks before the stock market opens, and you'll see what's going on. Sometimes you'll see a massive hit, like you'll see a point up or a point down. So big numbers up or down before the market even opens. Sometimes it's because of a news article, and we're going to talk about some of that right now. Here's some other things that you're going to find. The bottom, you're going to find the key stats. And the key stats in a stock are what determines whether the stock is a good stock or not. And we're going to go into that and talk about that right now. So let's talk about what the key stats are. This is just the same screen, just bigger from the bottom. So here's what's interesting. Here's the first thing. Today's high today's low, and the 10-day average volume. So what you're seeing here, today's high is, as you remember the chart from before, it was 117.20, and today's low is 115.43. Now that's a pretty big movement. That's almost a 2-point movement. That could have been a great day for a day trader or an options trader in one day. But most of the time, I'm not trading for one day. But it happens. I've been in and out of a stock in one day because it moved like this. Now that assumed that I got in at the 115.43 and got out at the 117.20. That's very hard to do. So that would have been a nice movement. But it's much not likely that that's where we're going to go. But there's what you see there. Then the 10-day average volume is 26.3 million shares traded average volume. So sometimes you can look and you can see today's volume, and you can say, hey, maybe today's volume's higher than normal or lower than normal, and that is something interesting to look at, because if it's lower than normal, you're like, oh, what's going on with the stock? If it's higher than normal, what's going on with the stock? So it's kind of neat. Okay, so the next thing you see is the year-to-date change and the one-year change. So the year-to-date change, so this stock, year-to-date, went up 10%, and the one-year change was 7.92%. So if you go 1 year back and you look at the stock, it's up 7.92%. And if you remember from the last webinar, you remember that the average return is about 7% in the stock market. So this stock pretty much went along with the average return of a stock market. The next thing you're going to see is beta, and the beta is an interesting indicator. The beta basically tells you that the stock may go up and may not go up. So basically, if it's a little more volatile, so basically a beta of 1.2 is theoretically 20% more volatile than the market. So the deal is basically with this, if a 1.2, 1.29, not a big deal. But you see a beta of 1.9, you know that this is a volatile stock. It's going to have some massive mood swings. So it's going to fly up and down real fast. That's what they're trying to show you here. And there may be other indicators of that as well, but that's what they're showing you here. So this is like not a big deal. It's a little more volatile than the regular market, but a beta of 1.29 is not a big deal. Matter of fact, I wouldn't count so much on beta as much as what I would look at would be support and resistance, which we will talk about in another module. Okay, so let's go back to here. Some other things, market cap and shares out. So the market capitalization is what it really is, and that is 617.6 billion. That means that's how much the company is worth. The amount of shares out there is 5.3 billion. So really interestingly enough, all you have to do, is take the market cap, and what the price of the shares are, how many shares there are, and that is the price of the company. So the price of the shares that you're paying. So it's just a little bit of math to figure out what the price is. So is it important? Not necessarily, but if you're comparing one company to another and you see that one company has more shares or less shares out and the cap rate's the same, well, maybe the company's more valued or less valued. So that's what that's there for. The next thing you're going to see, and that, by the way, that's if we do the math, the current stock price, as it said, is 116.52. All right. So the next thing is the dividend and the dividend yield. So some stocks pay a dividend, and a dividend is really simple. If you were to put your money in a bank and you were to get, in this case, you were to get a dividend of 2.28% every year, that would be your return. So basically you put money in the stock market, you buy stocks, and you get paid a dividend. So the nice thing about this is the dividend will give you a little bit of extra cash. So if you're in stocks and you want to live off stocks, you can live off the dividends. Now, it's not a very high percentage, obviously, right? 2.28, or even the yield of 1.97 is pretty low in today's, well, I shouldn't say in today's market. Actually, that's pretty high in today's market. That's pretty average in today's market compared to putting them, if you put the money in the bank. Now, understand, as a real estate investor and an options trader, my yields of my investments are huge Even my real estate yields are an average of 10 to 12%. So again, not the greatest thing, but a nice safe place to be. All right, so let's talk about what's going on here. By the way, again, that's the interest that's paid to you. So let's talk about the ratios and profitability and some of the other things in the chart. Okay, so EPS is earnings per share. Now, this is something good to know. And I would start taking some notes if you haven't already. I apologize, I should have told you earlier, but start taking some notes because this is interesting. Earnings per share is an important piece of your analytics of a stock. Thank you. Sorry about that. Okay, so the profit is divided by its number of common outstanding shares. So basically, earnings per share is how much did your share earn. So if you bought this stock, if you have one share, your share earned $8.28 of the amount of money you put in. So it's pretty good. Okay. The next thing is EBITDA. Now, EBITDA is earnings before interest, tax, depreciation, and amortization. What the hell does that mean? It doesn't mean a lot. Basically, what I would do is I would pretty much just forget about the words after earnings. Just know it's earnings, and now you can compare the earnings to, again, other stocks. And not that important to know, but it's nice to know that stock is getting high earnings, right? Okay. And basically, it's a measurement of company performance. Debt to equity. Now, this one is a great one. The number here, 67.86%. How much debt does the company have? The company only has 67% debt compared to its equity, which is phenomenal. I mean, if you think about your monthly bills and how much your debt to equity is, believe me, it's nowhere. It's probably closer to 100, or maybe sometimes even higher than 100. This is a very good stock. They have a lot of cash, is what this is telling you. Okay, high ratios are troublesome, obviously, right? This is the gross margin of the company. So the gross margin is the difference between the revenue and cost of goods sold divided by revenue expressed as a percentage. So basically, if they buy something for $1, they pretty much sell it for $1.40. You get it? $1.39.08. You get it? That's the gross margin. That doesn't take out other costs, but that's the gross margin, which is a great gross margin. Again, this is a very high numbers. I mean, you think about like car dealers who have gross margins of like 10%. This is a great number. All right? And of course, this is the net margin. The net margin is the percentage of revenue remaining after all operating expenses, interest, taxes, and preferred stock dividends have been deducted from a company's total revenue. So this is the real number. And again, a very good number. I mean, if you start to look at some supermarkets that do a 2% net margin, I mean, this is just a great number. This is a great stock. Obviously, this is Apple stock, and you can see why Apple stock is so great. I still can't believe that the price is as low as it is, and we're going to talk about that in a minute. All right, this is return on equity. How much profit a company generates with the money shareholders have invested. So they're taking your money and they're creating profit. 36.9%, again, a very good number. Okay, PE, stock price per earnings. This is a very important piece of information you need to know. And what this basically is, PE, is what the stock did, what the stock is doing per share. All right. It's how many times earnings is the stock selling for. Now, this is an interesting point, and I've made this in a couple of videos already. So typically, if you have a company, let's say you had a drugstore, a small drugstore. We're not talking about a big drugstore. We're talking about a small drugstore. And every year you made a profit of about $100,000. So let's say you made a $100,000 profit every year, and now you go to sell the company to someone else. How do you value the company? Well, you're obviously not going to sell the company for $100,000 because that's only 1 year's profit. So why would you sell the company for only 1 year's profit? What you're going to do is you're going to sell the company for a number higher than 1 year's profit. Typically, in a small business or a good small business, it's 5 to 6 times earnings. So you would sell that company for $500,000 to $600,000, and everybody would walk away happy. The people who bought it would make $100,000 a year, and they would put that towards the whatever debt they wanted to buy the company, or whatever it is they did, and then from that point on, they're making their own profit. So what this is showing you is that this company is selling for 14 times the earnings. Now, 14 times earnings is high, but not horribly high. Now, if you think about 14 times earnings, so basically Apple is saying, hey, if we were to sell Apple, the entire company to somebody, we would sell it at this current stock price. It would be 14 times the earnings, 14 times what we believe we can get for the company, what the company's making per year. All right. So earnings per share and PE are what this information is all about. So basically, earnings per share and the price per earnings makes the stock price 116.52 because price divided by EPS equals PE. Get it? So you have a stock price of 116.52. The earnings per share is 8.28. So you bought the company at 14 times earnings. So one more time, the price is 116. The EPS, the earnings per share, is 8.28. And the PE, price per earnings, is 13.99. All right? I just rounded it up to 14. Okay? PE is also called the multiple. So you'll hear people refer to PE as the multiple. What multiple is such and such stock selling at? This is an important piece of information because, again, when you're comparing stocks, you can see if one has a big multiple, one has a small multiple. The one with the smaller multiple is more likely to be a stock that either is very secure or it's more likely to go up, where a higher multiple has a more likelihood of going down. Now, that's for long-term stocks. Sometimes the difference between long-term trading and options trading is very different, but understand that's the multiple. All right? So, what is a good multiple? And basically, it's how much are you willing to pay more than what the company is worth, or what the company's current EPS is, right? So I want to show you something that's going to be kind of amazing. All right, let's check out the multiple of some commonly held companies, or things that make you go, huh? All right, check this out. Ford. The multiple on Ford is 6.04. So Ford is selling for 6 times earnings. That's actually pretty low, I believe, especially for a company like Ford. But hey, at least it's a decent number. It makes some sense, right? Now let's take a look at IBM. IBM is selling for 13.53. By the way, that's of this date, which is 1/1/2017, when I created these slides. So again, it's selling for a multiple of 13.53, and not a terribly high multiple. If you remember, Apple's multiple is a little bit more than that, not much more than that. So basically, they're saying that Apple and IBM have the same value. You get it? They pretty much have the same value. So Apple is worth what IBM is worth. IBM is worth what Apple is worth. Not market cap, not the total price of the company, but what you're paying per earnings, per share per earnings. Now Disney, the multiple is 18.22. So again, these are like some normal multiples, right? So if you look at some stocks and you see the multiples in some stocks, you're going to find varied numbers, but this is what you're going to find on these. Now, I want to go to some other stocks and show you something that makes my head scratch. The first thing is Facebook's multiple is 44.35. You're like, wow, 44.35? Apple's multiple was only 14. How could Facebook be 44.35? So this is how multiples kind of get out of hand. And what they're basically saying is we believe Facebook has so much growth potential that we're willing to pay almost 45 times the earnings because we know that very shortly it's going to be making 45 times the earnings, and that multiple is going to actually, and the price, the stock of the price is going to go up, and the multiple is going to go down because it's that good. So you get it, as the stock price goes up, if the earnings per share stay the same, then the multiple goes down. You with me? I hope so, but either way, just understand that that the fact is that they believe that this company is so good that they're willing to pay 45 times earnings. Now, I have to be honest with you. I agree. I think Facebook is that good. I think Facebook is going to it's going to take over the world. They already have, but no one realizes it yet. I always make the joke, if you ever saw the movie The Terminator, they had the Skynet. I think that Terminator was a real story. I think it was the truth. It really happened. Somebody came back from the future and told people to make the movie, but they didn't want to say that Skynet was Facebook because nobody would believe them. Anyway, so much for that joke. All right. Anyway, so Facebook is going to take over the world, so it has a decent multiple of 44.35. So check this out. Amazon. Amazon's multiple is 171.81. That's unbelievable. How can they think that Amazon is worth 172 times earnings? Well, they do. So it's kind of bizarre when you look at numbers like this and you see that Amazon's multiple is so high, you're like, what? It doesn't make any sense. Wait till you see Netflix. Take a guess what you think Netflix is. 300 and almost 33 times earnings. That's insane. That is absolutely insane. 333 times earnings. So to me, this stock is worth 1/10 or maybe 1/20th of what it's really worth in the stock price on a normal stock. A normal multiple of about 10 or 30, whatever it be, 10 or 20 would make this stock worth 1/20th the price. It's unbelievable that this multiple is so high. So check this out. I'm going to put in Google. Now, after you just saw Amazon and Netflix and Facebook, just start guessing at what you think Google is. I hear you guys listening to the webinar and going, oh, come on, it's got to be 500, 700, 1,000. Oh, come on, this number's got to be off the wall because it's Google, right? How about 28.95? What? Okay, so you see where multiples can get very confusing. Okay? So my suggestion is this week, check out some of your favorite companies. Go to certain companies, whatever you think it may be, Bristol Myers or whatever, and check out the multiples of the companies and see what the multiples are of those companies. And you may find it interesting. You may even want to go back and check some of these multiples too, because remember, the multiple changes every day because the stock prices changes every day. Now, sometimes a very small movement won't change the multiple that much, but a big movement of 5 or 10 points will obviously change the multiple. All right, so I would do that. I would check out some of your favorite companies. So here you go. So what makes stocks go up or down? Clearly, the multiple is so confusing that it can't be what it's all about, because if it was, I would just bet against Netflix all day long and say Netflix has to come down. But based on the reality of the last 3 or 4 months, Netflix just keeps going up. So basically, there are fund managers who control the stocks. So the big industrial fund managers, the hedge funds, the mutual funds, and all these funds like Fidelity and blah, 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 and all the funds you've ever heard of, they have fund managers. And the fund managers get paid to make money in these funds. So they get bonuses based on how much the funds have grown. So they have a big fear of not making their bonuses. And they also have a big greed to make their bonuses. So basically, here's what happens. You have a stock, and it goes up, and all of a sudden, you have fear. Oh my, I might be in too high, or I'm not going to buy anymore because I missed it. This stock's too high for me to buy, so I'm going to wait, and I'm going to stop buying. Then you got the stock goes down. Then you got greed. And greed comes in when the people say, hey, you know what? I'm going to buy this like crazy because I want to make my bonus this year. And that's it. This is what makes stocks go up or down. Fear and greed. It's also called support and resistance. Fear is resistance. Greed is support. So when we get into that module, remember, fear is resistance. Greed is support. So the fear and greed and support and resistance create small movements every day. And I need to tell you that small movements are the option trader's money-making opportunity. This is where we make money as options traders. So there are some other things that can affect a stock price. And some of these things are things like the earnings reports, news articles, and rumors. So let's talk about each one of these things. The first one is the earnings report. Earnings reports are quarterly and announced the month after the ending quarter. So, for example, the quarter ended on Facebook in December, so they would announce earnings sometime in January, maybe early February, but sometime in January, maybe early February, and because this way they have time to prepare the the audit or whatever they have to do, the accounting to do it, and they also have time to prepare a statement if the earnings aren't good, or if the earnings are really good, to prepare another statement, whatever it is. So it takes them about a month to create the earnings report. And if a company does well, the stock typically goes up, but not always. And it's kind of bizarre because you'll find that one of my biggest losses ever was betting on earnings, because I knew the stock was going to do really well, and they did really well. But there was something that was said in the report that made everybody panic. So, this is why one of the rules are betting on earnings is gambling. So if you think a stock is going to do really well and you're betting on the earnings by buying the stock or the options before earnings or right before earnings with an expiration date really close to after earnings, this is pure gambling. If they beat, they beat. If they don't beat, they don't beat. And if they beat, the stock goes up. The stock might go down. It might go up, even if they beat. So betting on earnings is gambling. And if you have the rules already, you'll know that this is one of my rules: is don't bet on earnings. I also tell you that there are times to break this rule. But if you break it by using all the other rules in conjunction with it, it won't hurt you, or it shouldn't hurt you. Okay, the other thing that can affect stock is news articles. Now, a bad news article could cause the stock to drop or rise quickly. And it's important to understand that the news articles are out of your control. There's nothing you can do. And here's the other thing that's really obnoxious. News articles are sometimes manipulative. So someone has a fund and they are shorting or betting on the market that a certain stock's going to go down, and they write a bad article about it. Oh, all they have to do at the end of their article is say that they own some. So if they just say they own some of the stock, then it's perfectly legal to write the article. So be careful that these articles can be manipulative. The other thing is rumors. Did you hear that this company is going to buy that company? Well, look, you're going to hear that all the time. As you start to follow this and start listening to reports and start reading news articles, you're going to hear about rumors. Now, look, the reality is most of the rumors are going on inside the hedge fund managers or the mutual fund managers. They're hearing the rumors and they're spreading the rumors, sometimes to be manipulative, sometimes because they think it's true, sometimes because they guess it's true. But the reality is by the time we hear it, it's too late. So forget it. Playing rumors is definitely not the way to go, because we just don't know what's going to happen. So they always say buy on the rumors, sell on the news. So the nice thing is the rumor may make the stock go up, and then we know that as soon as the news happens, the stock's going to go down. Now the interesting part is sometimes the rumor is true, and sometimes the rumor is false. Either way, the stock's going down. If the rumor is false, the stock's going down pretty far. If the rumor is true, the stock's going down a little bit because people have already anticipated that rumor. But again, by the time we hear about it, it's too late. So let's talk about stocks going up and down. Remember, it all comes back to fear and greed, support and resistance. It's the same thing over and over again. So this is why, literally, a buy and hold stock portfolio is a long-term investment. And sometimes it's a very long-term investment. So take a look at this stock. This is actually Microsoft stock. And take a look at where it was in 2007-8. It was at 30. Now take a look at where it was in 2013. Same exact spot. Now you can see the big dip. This was the 2008 crash. But if you take that dip out, the stock relatively stayed the same price the entire time for the last 7 or 8 years, or from 2007 to 2013. It didn't make any moves until here, and it doubled in that time. So from 2013 to 2017 ish, it doubled. So it's kind of bizarre that this was a long-term strategy. Now, it is true that the stock doubled over 10 years, which, by the way, if you do the math and you use the rule of 72, you realize that if you took the average, it's about 7 to 7.5% return on your money. So if you put the money in 2007 and you sat on it until 2017, you about doubled your money and you made about 7 to 7.5% interest. It's amazing, isn't it? But check this out. This part right here is an option trader's dream. Okay, this is the pattern. See it up, down, up, down, up, down, up, down, up, down. I grab a couple, goes to 30, goes to 25, goes to 30, goes to 25, goes to 30, 25, 30, 30, 25. That's what I'm looking for. This would have been, it's not anymore, this would have been a great stock options pattern. So let's talk about what the stock market really is. So the stock market is simply the market in which shares of publicly held companies are issued and traded either through exchanges or over-the-counter markets. So the NASDAQ is something you've heard of, and it stands for National Association of Securities Dealers Automated Quotations. Who cares? It's the NASDAQ. And then the NASDAQ, they usually trade tech stocks. So if you were to have a supermarket, right? A supermarket that sold a certain amount, a certain type of, let's not use the word supermarket, but a department store that sells mostly the same thing, this department store called NASDAQ sells tech stocks. So traded on the NASDAQ is typically tech stocks. And the main component, the main index that you see the numbers, they talk about the NASDAQ hit 5,000 today, blah, blah, blah. That is a NASDAQ composite index, which has been created since its inception, and people use that number to see as a gauge of how tech stocks or NASDAQ traded stocks are doing. So the AMEX stock exchange, the American Stock Exchange, is also a stock exchange. And actually, it's no longer called AMEX. It's now called New York Stock Exchange. So if you heard New York Stock Exchange, this is another stock exchange. So this is another department store that you can buy stocks. So the stocks listed in NASDAQ are not listed anywhere else. They're only listed in NASDAQ. The stocks listed in NYSE are only listed in NYSE. You can only buy it from that department store. There are other exchanges. Okay, there's also the Tokyo Stock Exchange, the London Stock Exchange, the Shanghai Stock Exchange, and others. So these are exchanges that you may hear about. There's something else called over-the-counter. And basically, over-the-counter stocks are not sold in markets. They're basically sold directly between two parties without the supervision of an exchange. So basically, sometimes they're called pink slips. And basically what they are is, you say, you want to buy this company's stock. The company is probably so small that they can't afford to be traded on an exchange because it's expensive to be listed on an exchange. So they can't afford to be traded on an exchange. So you hand them $1, they hand you a pink slip that says you bought one share of the stock, assuming the stock was $1. And typically, you'll find some of the over-counter stocks to be 50 cents, a quarter, $1. Typically anything under $5 is probably listed as an over-the-counter stock. You'll hear about some stocks that get thrown off exchanges, like they've been thrown off the NASDAQ, they've been thrown off the New York Stock Exchange because their price is so low that they don't want to have the liability of holding that stock. Citicorp a few years ago did a reverse split, which meant that they basically have less shares out there, but makes the share price higher because Citicorp couldn't get their stock price to go over 5. So it was sitting there between 3 and 5 with the fear of being thrown off one of the exchanges. So that's why they did actually a 10-to-1 reverse split. So what was 3 became 30, but you had 1 share for every 10. So that's how a stock split works. There's another thing called the Chicago Board of Options Exchange, the CBOE, and this is very important to me because I trade options, and I trade options, and typically my options are traded in the Chicago board. Now, here's the thing: you don't really need to know that your options are traded in the board, but what's really nice to know about options is that there's always a buyer and there's always a seller of options. Don't worry about who ends up with them. Don't worry about if the person who ends up with them is making money or losing money. You only have to worry about if you make or lose money. The neat thing about the board is you don't need to look for buyers. The board is telling you there's a buyer at this price. There's always a buyer at this price. We'll talk about bid and ask in another webinar, but again, it's always about a buyer always being there. So if you want to sell your options, you can always sell them. You want to buy an option, you can always buy it. Here's a couple of things that you might have seen. Again, if you go to CNBC and you look at the front page, it'll show these typically on every page. And these are important indicators of what the stock market is doing. So the first one is the Dow Jones Industrial Average. The next one is the S&P 500. The next one is the NASDAQ. That's the NASDAQ component we talked about before. The Russell 2000 and the VIX. So let's go through these. The Dow Jones Industrial Average, the DJIA, was created by a Wall Street journalist, and basically it's an average of 30 popular stocks. And they change occasionally, but if you take a look, you can actually just type in, if you want to type in Google and type in the Dow Jones Industrial Average 30 stocks, it'll tell you what they are. So these stocks, using some crazy formula that adjusts for splits and dividends, comes up with an average, which is really an indicator of how the stock market is doing. So when the stock market is up, they say, oh, the Dow's up 200 points today. That means that these 30 stocks, if you average them all, they're up 200. Now, there could be certain stocks in the Dow that went down that day, but most of the stocks went up, so it rose the average. Do I know what the formula is? No. Do I care what the formula is? No. You don't even need to care. You just need to know that the Dow Jones Industrial Average, the DJIA, when it's up, it's great. When it's down, it's bad, right? Simple as that. Okay. The next one is the S&P 500. And basically, the S&P 500 is made up of 500 large cap stocks picked from both the NASDAQ and the New York Stock Exchange. So they're taking two exchanges. They're taking the New York Stock Exchange, they're taking the NASDAQ, and they're picking 500 large cap stocks. So 500 large cap stocks are stocks that are very big companies. And they're taking an average of those, and they're coming up with a number for the S&P 500. So when the S&P 500 is up, it's really good. When the S&P 500 is down, it's really bad. You'll also see that the NASDAQ will kind of go along with the S&P 500 most of the time. And you'll see that only because some of the stocks that they're picking from the NASDAQ and the New York Stock Exchange are on the Dow. So here's the Russell 2000. I bet you can guess how many stocks the Russell 2000 is made up of. You guessed it, 2,000 small cap stocks. So this is the opposite of, well, I'm not going to say the opposite of the S&P 500. The S&P 500 is large caps, and the Russell 2000 is small caps. So they're smaller companies. So a lot of small companies, a lot of mutual funds invest in small companies. And because of that, the Russell 2000 is a good indicator of how well mutual funds are doing in that day or in that month. The VIX, this is an important number or important piece of information for a stock options trader. So what the VIX is, it's a ticker symbol for the Chicago Board of Options Volatility Index. And basically, this is a fear index. And people call it the fear index or the fear gauge. So when the VIX is, when I showed in this example, I think the VIX was about 11-ish. It's actually a great number. When the VIX starts hitting 25 and above, the stocks start to get more volatile. It's similar to the beta. If you remember the beta, when we talked about the stocks, right? So the beta of 29 was said it was more volatile. Well, I actually should say that because 129 is not too bad, or 1.29 is not too bad, where a 29 VIX is pretty bad. If the VIX reaches 35.40, there's some major things about to happen in the stock market. So it's a bad time to get in, or a good time maybe to get puts, or just you're going to see some crazy movements up and down. I know I did very well last year when the VIX was around 28.30. I did very well because the stocks were moving so fast. I was able to pull up a bunch of money. So here they are: the Dow Jones Industrial Average, the S&P 500, the Nasdaq, the Russell 2000, and the VIX. Okay, I'm going to give you guys an assignment before you go on to the next webinar. Now, please take a while, digest this, maybe go through it a couple of times, but this is your assignment. I want you to pick 6 stocks, and I want you to follow them. I go to CNBC.com. It's very simple. So, very simple. Go to CNBC.com, pick 6 stocks. You may want to pick the 6 that I follow that you see in my videos every day. You may want to pick 6 of your own. Doesn't matter. Look up the EPS and the multiples and other data that we talked about. Follow the indicators and see how they affect the stocks you're following. So if the Dow's up, does your stock go up? If the Dow's down, does your stock go down? Again, NASDAQ up, NASDAQ down, you know what I mean? So see how they're affecting the stocks you're following. So start looking at stocks for the next week before you open up the next webinar, or at least a few days, and make sure that you're doing this and you're learning. You're actually learning how to value stocks. Find it interesting. Look at Netflix and watch the multiple go up and down. Look at other stocks, maybe a stock like GM or a stock like Procter & Gamble, which is a very stable stock. And you'll see that those multiples are probably much lower. But again, look at them. So start looking at them and start understanding them. So that's it for this webinar. This module is over. It's the module on the stock market. I'm hoping you learned a lot, and I want you to study it and I want you to understand it before we go to the next module. Have an awesome, profitable week. Take care. This is Larry Steinhaus, the Crazy Options Trader, signing off.